Adesso è davvero con vero piacere che vi presento Pavan Sukhdev, che è ambasciatore, Goodwill Ambassador delle Nazioni Unite, degli UNEP, dell'Organizzazione delle Nazioni Unite per la Protezione Ambientale. Sukhdev ha lavorato in Deutsche Bank, ha fondato e presieduto il Global Market Center di Mumbai. È stato poi consigliere speciale e capo della Green Economy Initiative dell'UNEP e ha coordinato il progetto The Economics of Ecosystems and Biodiversity, commissionato alle Nazioni Unite dalla Commissione Europea e dal governo tedesco. È tra i fondatori di GIST, una società di consulenza ambientale che aiuta i governi e le imprese a gestire il loro impatto sul capitale naturale e umano. Ed è anche autore di Corporation 2020, ovvero trasformare le imprese per il mondo di domani. Io, nel dare la parola al dottor Sukhdev, voglio leggervi soltanto una frase riportata nel libro, in cui lui parla del tipo di crescita, in realtà è una frase di Tom Lovejoy, in cui definisce, diciamo, con una metafora molto semplice il tipo di crescita di cui abbiamo bisogno. Dice: abbiamo bisogno di una crescita che sia l'equivalente economico di un bruco che diventa una farfalla. Mr. Sukhdev.
Thank you for the kind introduction and the reference to my book and its Italian translation. Friends, it's my pleasure to be with you here today. And firstly, congratulations on such a huge conference on an issue which I think deserves a huge conference, which is the sustainability of our economies and the business model that we are following, not just at the macro level, which mainly we are focusing on, and the policy level, but also at the micro level of the corporation. And the two are connected. So today, the next 20 minutes, I would like to share some thoughts on business and the green economy, and draw some lessons from the work that I did at Yale University. Some people thought I was crazy when I left the United Nations. That's a good job. And at the same time, I also resigned from Deutsche Bank. That's another very good job, because I was on secondment from Deutsche to the United Nations. But I was going to Yale University for a purpose. One was to write this book, and the other was to teach my project, TEEB, the Economics of Ecosystems and Biodiversity. It's a long name for the economics of nature, understanding what nature brings to the economy and to society, and especially in areas of poverty and development. So maybe not so mad, but I'll draw a few lessons from there. But today's main focus is on business and the green economy. And I was pleased to see that the issue of growth has already been touched upon in your Undersecretary's message, looking at growth and green growth, what kind of growth do we want? I begin with an example of perhaps the kind of growth that we may not want. So this is a video from YouTube prepared by the NEF, the New Economics Foundation. It's in English.
A hamster doubles its weight each week. If it didn't stop when mature, as animals do, and continue to double on its first birthday, we would be staring at another big, tough hamster. This hamster could eat all of the corn produced annually worldwide in a single day, and still be hungry. There is a reason why, in nature, things grow in size only to a certain point. So why do most economists and politicians think that the economy can grow forever and ever and ever?
So is this our future, becoming the huge and fat hamster floating into space? But I think the kind of growth that we are talking about clearly is not what we are heading towards or trying to achieve in the brown economy. We are talking about growth in value, growth in capitals, not growth in flow. Yeah, it's like having a tank of water above your house in a desert area and saying, wow, I'm so clever, I can run this water really fast. Yes, it'll look like growth because it's flowing faster, but at the same time, the tank level is getting lower. So there's a difference between stocks and flows, and we tend to measure value addition mainly in flow terms, and that's part of the problem. If we start measuring growth in stock terms, in terms of the capitals, one of the ways of doing that is called inclusive wealth. It was started by Kenneth Arrow and Partha Gupta and Carl-Jürgen Mailer, one of my gurus, advisory board member of TEEB. And here's some results from the Inclusive Green Economy report, in which I was leading the writing, but Partha Gupta has prepared these numbers. So here's the way in which actual wealth, in other words, human, natural, and physical and financial capital, if you look at wealth as capital stocks, here's how it has grown between 1990 and 2010 in the continents of Western Europe on the top, Eastern Europe, Asia Pacific, Latin America, and Africa. And you can see that even though physical capital, which is manufactured items, have grown, but in fact natural capital has declined everywhere, and human capital has grown more or less, and especially in Europe. In fact, that's good news. Human capital growing means skills, intellect, health improving, and that's good news. But the sad news is, of course, Africa, there is net negative growth if you account for the natural capital. And even in Latin America, there's hardly any real growth. So even though some of these economies may appear to show high rates of GDP growth, in fact, that's not really a real reflection of the state of society or the state of the economy. Why is this happening? Why are we in a situation where we have growth in GDP, but not real growth in wealth? That's because if we look inside GDP, and let's take how we measure GDP, we total up profits, corporate profits, we total up salaries, rentals, interest, and other such things. Unfortunately, we don't account for the other side. We account for private profits, but we don't account for public losses. It's strange that I should be saying this in Italy, which is the home of double-entry bookkeeping, which every company in the world uses for accounting for its balance sheet and profit and loss. Unfortunately, governments don't do that. They should, because they are responsible for the entire balance sheet of the nation, which includes natural capital, human capital, social capital, and financial capital. But the transactions they account for are partially accounted. They don't account. They account for the private profits, but not for the public losses. That's kind of strange if you're a government, but that's what the accounting system is like. And because they don't account for it, this happens. These are the negative externalities of the private sector. Private profits, public losses. And how big are they? We are talking about, for the top 3,000 companies, this is a research report from TrueCost for the United Nations Principle for Responsible Investment. $2.1 trillion, that's 3.5% of global GDP, losses in social value in terms of climate damages, in terms of freshwater extraction, in terms of pollutants, and so on. And the three big areas of damage actually are mainly greenhouse gases and water and natural resources, and hence the issues of scarcities. These behaviors of creating private profits and public losses are actually institutionalized by the evolution of the corporation, which I've written about. The way it behaves today is the result of history, of more than 100 years of history, between 1820 and 1920, when laws were changed to give the corporation limited liability, to give the corporation a persona. In other words, it's a being. It has the right to do almost anything except voting. Thank God for that. Can you imagine if corporations, apart from the right to sue and be sued, also had the right to vote? You had millions of corporations being listed just to... You might, of course, argue that the dollar gets paid to the politician, and therefore there is a de facto right to vote. And that's why public capture takes place. But these are the kind of behaviors that typically are built into today's model of the corporation. There is a serious pursuit of size. Big is beautiful, because the more you sell, the more you can take a margin and profits ultimately for shareholders is the target. There is a huge investment of senior management time and energy in lobbying. Lobbying not necessarily for the right reasons, which is to improve the industry, but lobbying to keep out competition, lobbying to keep out imports, lobbying to keep your existing control over your kind of energy, for example, or your kind of manufacture, and keep competition away. And that's why it's good to hear the State Secretary and others talking about investing in the SMEs and giving them a more level playing field, because some of the best innovation and ideas come from there, and sometimes they don't travel very far. They can be quashed and bought and quashed by the incumbents. So work needs to be done there. Another dimension of today's cooperation is leverage. Time after time after time, because of the misuse of leverage or the abuse of leverage or the excessive use of leverage, as in the borrowing of companies, late 1970s, the Latin American debt crisis, governments borrowing too much in Latin America. Early 1980s, the savings and loans crisis in the US, small banks trying to become like investment banking traders, just borrowing. Then, of course, the Asian debt crisis in 1998. Then, of course, the most recent 2008-9 crisis was basically, again, misuse of leverage. And yet, we don't seem to control it. To this day, companies can borrow what they can, what the market will bear. That's the situation we have. Central banks constantly use the monetary lever, but they don't think as to where the problem is coming from. It is coming from misuse, abuse, and excessive use of leverage. It's difficult for a banker like me to say this, but this is my considered opinion, and there's a fair amount of research I've done in this area. And then lastly, and not the least, actually, advertising without ethics. We are in a world today where advertising is pervasive, 24/7, all the time. There's some message or the other coming, which will convert some fundamental insecurity or shortage that we have into some kind of a want. That want becomes a need. The need becomes demand. The demand becomes production. The production becomes volume. The volume becomes profits. Constant cycle of churning insecurities into profits. And that's, I think, part of the underlying issues. And just to give you, and I can, in my book there are many examples, but I'll give you two examples which have come up in the press recently, and maybe comment on one example of the pursuit of size and another example of aggressive lobbying. And the two companies I've considered is Volkswagen and ExxonMobil. Cooperation 1920, I call it, because that's the turning point. And around that time of 1920, the Dodge versus Ford court case in 1919 actually took place, in which the judge famously, in his dicta, on a case against Henry Ford by the Dodge brothers, who were 10% minority holders, basically argued that Henry Ford was persecuting the minority and that he should know better than to work against the interests of his shareholders, hence establishing the sort of culture that somehow the corporation is only for the shareholders, nothing else. But let me come back to Volkswagen and the pursuit of size. It was their ambition to be bigger than Toyota, probably still is. But the means that they chose to do that, to pushing the diesel engine and basically disguising through cheating software the true emissions impacts of diesel engines, is something that has come out of greed and a lack of ethics. And the question is, were they the only ones? And apparently recent research done at Leeds University in the UK, very recent, last couple of weeks, has come out to show that, in fact, it's not just them, it's also Mercedes-Benz, also BMW, also Mazda, and also Ford. And that all diesel engines basically have this kind of cheating software installed inside them. And the irony is that actually the Volkswagen cheating software and the others, the Volkswagens are in fact less, shall I say, less offensive. In other words, the multiple times by which they exceed the official limit is less bad compared to the others. But of course, everyone is 5, 6, 7, 8 times the official limits. So here's some of the challenges that will face the policymakers. What do you do with this entire sector of diesel engines? Of course, the whole idea of diesel being fuel efficient is thrown out of the window. They clearly are not going to be fuel efficient if they drive the cars in the proper way as they should be driven. But that's really something between the regulators and the customers. The issues here are to do with ethics and how the corporate profit focus overrides ethics. And this is about also another dimension of the corporation which needs to be looked at, aligning corporate purpose with social purpose. It should not be the case that it's normal for you to make private profits and public losses. It should be the case that it is normal to make private profits and public wealth increases. The other example is of aggressive lobbying, which came out in the public more recently as a result of some research done by newspapers, is that Exxon knew as far back as July 1977, when James Black, who was a top scientist at Exxon, had presented to the top management of Exxon on the climate impacts of fossil fuels. And in fact, they validated his experiments and advice by running experiments on some of their ships, actually measuring carbon dioxide concentration. So they had some of the best climate science. And after that, after they had decided and determined that this was true, they spent a lot of money and a lot of energy and time denying the reality of climate change, paying for fake science and unprincipled scientists to present opposite views so that they could confuse and muddy the waters and basically continue doing business as usual. So this denial campaign of aggressive lobbying basically is, again, part of what, in my opinion, Exxon is accountable for. And it is, again, an example of pursuing private profits at the expense of public losses. These are the kinds of behaviors at the micro level which completely distort the economy. Today, the corporation, the private sector, is 70% of jobs and 65% of GDP. In the US, it is 74 and 75% respectively of GDP and jobs. So there is no way in which we can have an inclusive green economy or a circular economy unless we change the agent of the economy. Because at the end of the day, the economy, its profits, its salaries, its taxes, its rents, is basically comprised of the micro level. You cannot have a different macro world if the micro world is rotten. And that's the situation we are in today. We are still in the world of Corporation 1920, and we are, if I may remind you, in the 21st century. Now, we do need a new kind of corporation, and here are, and I've discussed this at length, but in summary, here's what the kind of corporation is required, which is its goals are aligned with society, so it has a social purpose. It is kind of a capital factory because it recognizes its impacts not just on financial capital, but also on human, social, natural capital, and measures them and manages its externalities. It tries to reduce negative externalities and increase positive externalities. It's an institute. It trains human beings to be able to earn better and live better. It's a community. It respects its suppliers, its customers, its employees. It creates, in fact, overlapping communities and builds them, creates the networks that are required for people to live together. And finally, it's the guardian of natural capital, not just a parasite, not just a locust, more like a guardian. And this kind of corporation will generate the kind of growth that Tom Lovejoy spoke about, which is the growth of a caterpillar becoming a pupa, becoming a butterfly. It's growth in complexity. It's growth in value. It's not just growth in size, which seems to be the only thing that we measure nowadays. That kind of corporation will actually automatically generate an inclusive green economy. So, and the benefits of the inclusive green economy are there based on the modeling that's been done by the United Nations Environment Programme and the economists who were part of our report in 2011, and it's been well evaluated. So we would see, as a result of this kind of economy, merely with just an investment of 2% of GDP, which means basically 1/10 of gross capital formation. If that could change direction from being in the traditional business as usual towards a green economy, then that would automatically increase, as you can see, substantial reductions in footprint, increase in forest cover, decrease in water demand per capita, a huge decrease in energy demand per capita because of energy efficiency and availability. And actually, after an initial decline, even an increase in the traditional metric of GDP. So even though I'm not a believer in the way that that is measured. So these are some of the effects, modeled effects of an inclusive green economy. And it has certain design principles, and I've listed these here. The first of them, and to me still the most important of them, is the centrality of jobs in this. And this is why I think we absolutely need to look at the green economy and especially ideas of the circular economy, which I will come to in a minute. Another design principle is the focus on investing in public wealth. not merely in promoting private profits. And I think that means building up ecological infrastructure and building institutions, building laws to enable the new kind of economy to work. It means also rethinking subsidies. We cannot have a situation where we have got subsidies. Unfortunately, I think even in Europe, we are not quite there yet. The IMF estimated the fossil fuel subsidies in Europe at $303 billion. That's huge, considering the size of the economy of Europe, and that has to stop. It cannot be the case that you are subsidizing fossil fuels to the same extent that you are raising environmental taxes, which is also about $300 billion. It doesn't make any sense. So that really has to be looked at. And there are issues, I think, in terms of interpretation. And there is, in the EU Commission, one of the directives in the Energy Taxation Directive has a state aid rule, which basically is interpreted by the Commission itself as saying that the tax that you apply for renewable energy should be the same as what you apply for fossil fuels. But then what's the point of a tax? I don't really understand the logic here. So there are areas which I think, even though Europe is a leader and Italy within Europe is a leader, I think there are still areas where we can seriously look at improving how things are managed. I think on the positive side, there is a huge amount of initiative and energy in innovations towards a circular economy. And to me, a circular economy is really the more intelligent way of managing the economy, because here you're seeking value. You're not just seeking profits. And you're seeking value by, this is a diagram which is from Ellen MacArthur's foundation, and they have drawn separately the technical flows on the right-hand side and the biological flows on the left-hand side, and demonstrated how at each level of the circle in the circular economy, at each level, you are trying to capture the best value out of the resource, you're trying to optimize its efficiency, you're trying to maintain what you have produced, you're trying to manage it. So at each level, there's an element of service delivery that is taking place, as against just the traditional model of take, make, waste. Take, make, waste, right? Any machine can do that. But to have a service-oriented circular economy where at each level you're optimizing the utility and the value of the component of material that you're using, be it biological material or be it technical materials, electronics and so on. You're actually creating more jobs in the service sector. That's what drives the higher job content of a circular economy. To me, in Europe, the circular economy and whatever you can do to eliminate perverse subsidies and to increase incentives for new initiatives towards a circular economy, that is the solution to the jobs problem that we have today in Europe. It's not investing more in energy subsidies and fossil fuels. I don't think that's going to give the answer. How do we do this, though? So I think I mentioned a couple of examples of how the transition, which does require a refocus and a rethink of some of the regulation. And I think it's good that the Undersecretary mentioned the simplification of rules, and he talked about transparency and accuracy. Well, amongst those, I think the Energy Taxation Directive of the European Union Commission does need a bit of rule simplification and clarification as to, is it really the case that fossil fuel should be taxed the same as renewable energy? On what logic? So I think, and these are some of the, if you like, low-hanging fruit, which one can address from a policy driver. But there's also other areas, and I think we need to recognize that fixing the macro level, fixing the issues at the macro level, subsidies, taxes, investing more in the go green and the areas of the new economy, green economy, and making sure that the public procurement is more towards the green economy, that there is greening of public procurement. These are issues which the government can do, but I think equally governments and companies should look at micro-level policy. Micro-policy changes are also required because, like I said, 2/3 to 3/4 of almost any economy is the private sector. You can't really have a driver of the economy moving in this direction and then you hope that the economy will move in that direction. And to me, these are the key 4 changes that are required in micro-policy reforms. I think advertising accountability is critical. There are principles and strategies that we can follow, including a disclosure of footprint, disclosure of the origins of the product, clear instructions on the recycling of the product and so on, and also point-of-sale information. And I think this has to be worked directly with advertising associations, because you do need, in each of these planks of change, you do need one regulator to be involved in it. And to me, the advertising associations are the only ones in this particular domain. As far as leverage is concerned, frankly, central banks have to just be real and understand where the driver of the risk is coming from, and then address the key issues. And there's literally a bank of instruments and strategies that you can follow to better control leverage. There are the old-fashioned ways of creating consortium banking. There are the new ways of creating capital constraints and capital requirements based on leverage. And then there's even the common sense ways. I can never forget, I asked the chairman of Walmart, Rob Walton, in one of the interviews I did for Corporation 2020, I said, look, company of your size, $470 billion, you were not that big in the 1980s, but you must have been seriously stretched because of the volatility in interest rate and the liquidity crisis that took place in the US then. How did you manage your funding? And he says, oh yeah, but my dad was really concerned well before that about how much money we borrowed from you banks. So I said, really? How much did you borrow from us banks? He says, oh, $1,300,000. So his dad took the company public because $1 million was too much to borrow from the banks. He made it a public company. Therefore, they didn't have a problem at that time. They never had the kind of leverage that you would imagine a company of that size to have. So their common sense can also solve these problems sometimes. And finally, I come to resource taxation, which is a big concern of mine, is that we are constantly taxing the goods and not taxing the bads. I argue for a reduction in corporation tax. I say that you should tax resources. I say that you should tax unused land. I say you should tax basically the bads, which is emissions. That's taxing a resource. It's the atmospheric resource and our impacts on that resource. So I do believe, and I agree with earlier speakers who talked about the importance of using the taxation driver more intelligently towards the economy that we want. And I do believe also that it's actually more effective than using the markets route, because that involves other assumptions as to how you set caps. The cap and trade market is not the trade that's difficult, that's the easy part. It's setting the caps, that's the difficult part. So I think we need to rethink on taxation and look more at resources, on resource use and resource extraction, and try and reduce taxing the goods. After all, hard work is a good thing. We earn salaries because of hard work, but we tax that. Innovation, enterprise, ingenuity are good things. We're going to promote that, but then value addition is taxed in the corporate side. So I think the thinking here needs to be really fundamentally re-examined. And finally, and to me, this is where I think we are making progress a little bit, disclosing externalities. It cannot be that the company with its beautiful double-entry bookkeeping and accounts, annual accounts, is disclosing profits and balance sheet, is disclosing directors' bonuses, which are already part of the P&L, is disclosing contingent liabilities, which are not happened yet, is disclosing post-balance sheet events, and all kinds of other things are disclosed because someone asked for them. But you don't disclose your externalities. So directors' bonuses, maybe $5, $10 million, $20 million, you disclose. Contingent liabilities, maybe $100 million, you will disclose. But externalities, billions of dollars, no, we don't want to disclose that. Like, what kind of sense does this make? Yeah, and I think this is, I'll come back to it, but this is actually a good news area because finally this penny has dropped and things are moving. And another dimension is the Sustainable Development Goals. Here's a little diagram which comes from the World Business Council for Sustainable Development, which is about how a company can use as a process all of the 17 Sustainable Development Goals and understand where its actions on society, its impacts on human, social, and natural capital can be understood better and incorporated better into its philosophy and its business strategy. And I think that is, if that could happen, then, and if more people try to use this approach as a means of evaluating business strategies, and I think that could overall have quite a solid positive effect on the economy. One area where I'm delighted to be able to report some good news is on the investor side. Here are some numbers compiled by the Global Sustainable Investment Alliance based on a whole series of investor groups who reported into them. There are two interesting things about these numbers. These are the total assets which are marked in investor portfolios, whether they are pension funds, provident funds, or insurance companies, or real money accounts of any other kind. These are the assets that are marked as being acceptable as an SRI investment or acceptable as an ESG investment. And this category has been growing dramatically, grown from 13.2 trillion to 21.4 trillion over 2 years. That's a 60% growth over just 2 years. And what is also remarkable, these are not small numbers. Of course, I've seen huge growth rates in things like credit derivatives and interest rate derivatives. They begin with a small base. But these are beginning with a big base because at $21 trillion, it is almost 10% of the total financial asset class. We have something like $160 trillion of bonds and $60 trillion of equity right now. So that's 220 plus. So this is now no longer a boutique area. These kind of assets are actually quite big. An example of what this means is that sometime back, Telia, the Swedish company, disinvested in Eastern Europe because of issues to do with basically bribery and corruption and governance issues there. And some commentators thought that the stock price of Telia would drop because Eastern Europe was one of their most profitable units. But in fact, the share price of Telia went up. And my theory is that it went up because you had thousands of rating agencies and analysts and banking analysts sitting there and going tick, 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 saying, Telia, yes, include in portfolio, yes, include in portfolio. And then a number of traders in desks picking up the phones to brokers saying, buy Telia, buy Telia, buy Telia. That creates demand in the stock markets, and therefore you had exactly the opposite effect on the stock price of Telia compared to what some analysts had predicted. And last but not the least, again, an example of leadership here is that the regulators are beginning to wake up, beginning with Europe. So here's the directive from the EU from October last year, which basically asks for companies to start measuring their impacts, not just on shareholder wealth, which is the small box of privately owned shareholder capital, but the big box of natural, human, social, and financial capital, belonging not just to you, the company, but belonging to people, society, and the world. That kind of approach, I think, is finally what's going to change the needle, because that need to report the reality, I think, is absolutely critical. You cannot manage what you do not measure. Today, we don't measure anything except our impacts on shareholders. When we start measuring as companies, start measuring our impacts on stakeholders, then we will start managing that. That's the future that we need. And friends, I'm pleased to tell you that the future is not that far away. This is here. I'm reporting a recent piece of work that was done by AkzoNobel, which is a chemical company, part Swedish, part Dutch, who actually completed a full analysis of all the capital impacts of their Brazilian division, Pulp and Performance Chemicals division. They have actually measured in hard number terms what is the impact on human and natural and financial and social capital. It's not only the financial numbers that are measured. There are also other factors when you measure social capital. But the interesting thing is they've been bold enough to report the negatives and the positives. And there are, of course, both negatives and positives. They've reported it separately, not making any mistake as confusing that you can make a loss in human capital or natural capital because you made a profit in financial. They're reporting each dimension of value separately. And I think that is the way forward. So this is not theory. This is actually already happening. I'm already working, as of just yesterday, I was in Sweden, and I was working with another company whose name I cannot disclose, who is considering doing the same, and they're huge. So if we can only have these leaders, not just as isolated examples, if we can only have followership, not just leadership, if we can only have governments and policymakers focus on leveling the football field and producing the rules out there which will force everyone to follow the leaders, what a different world and a different economy we would have. And that, my friends, is the inclusive green economy, one which is circular in principle, one which manages waste, designs properly, and delivers well-being without delivering simultaneously a huge cost to society and the environment. I know that you people are all wanting to go there, so am I. Let's work together, and I hope we can do this. Thank you.